Two people, same city, same job, same salary. One retires at 55 with more money than they'll ever spend. The other hits 65 still wondering if they'll ever stop working. Same income, completely different lives. What was the difference? I'll tell you. But the answer is probably not what you think. Investing is how ordinary people become wealthy, not the result of wealth, the cause of it. Most people have that backwards, and that single reversal costs them decades of financial progress. Strip away all the noise, and investing is simple. You take money you have today and put it somewhere to grow into more tomorrow. The question is where you put it, and that's where it gets interesting. When a company needs capital to grow, it sells ownership. Those pieces are called stocks. Buy a stock, and you become a part owner of that business. If the company grows, your stake grows with it. But here's the misunderstanding. Successful investors aren't trying to pick the next Apple or Amazon. That's gambling dressed up as investing. What if you didn't have to pick the right company at all? What if you could own a small piece of 500 companies? You'd win whenever the American economy grows. That's exactly what an index fund does. It tracks the whole market, not just one company's fate. And here's the uncomfortable truth. Index funds usually outperform the majority of professional managers. The people paid millions to beat the market often don't. A simple index fund usually does. So why doesn't everyone just do that? Because people wait. They watch the market. They wait for it to dip. They wait until they feel ready. But that waiting is one of the most expensive habits. There is always a reason to wait. But every month on the sidelines is a month of potential growth lost. And this brings me to a critical number. What matters more in investing? How much you invest or when you start? Most people say how much. Most people are wrong. Meet Maya and Daniel. Both are 25, same income, same monthly investment, $300. Maya starts today. Daniel waits 10 years. By 65, Maya has invested for 40 years. Daniel has invested for 30. Just a 10-year gap. But here's the number. Maya ends up with $800,000. Daniel ends up with $350,000. Same investment, same return. Almost $500,000 apart, purely because of 10 years. That gap has a name, compound growth. Your returns generate their own returns. Gains grow gains of their own. The longer it runs, the faster it accelerates, exponentially. Maya didn't invest more than Daniel. She just started earlier. Time did the rest. So if this is clear, why do most people still never start? 3 barriers. The third one is the most dangerous, because it's invisible. The first, thinking you need a lot of money. You don't. Many platforms let you start with $1. The habit matters more than the amount. The second, fear of losing money. Long-term investors who stay the course recover. Those who lose money panic sell at the bottom. The third, the invisible one, is manufactured complexity. Entire industries exist to make investing seem too complicated. Dense jargon, intimidating charts, endless options. A confused investor is dependent on advisors who charge fees. Research shows a simple index fund outperforms most options. Complexity is their business model. Simplicity is our strategy. The version of you that waits 10 years will look back and regret. Open a brokerage account. Buy a broad index fund. Set up automatic contributions. Then leave it alone. That is the real strategy, validated by decades of data. The wealthy aren't wealthy because they found secret stocks. They're wealthy because they understood time in the market beats timing the market every time.